Good afternoon, folks. Welcome to Liberty Call for Tuesday, the 19th of July, 2022. Hope everybody's having a fantastic day out there. Pretty good day in the markets. Looks like across the board, lots of green. Maybe not so much over in the Asian markets last night, but across Europe and the United States, things looked really good. So, again, do not do not let a couple days make a long-term trend. We can look at the long-term charts in a minute and see where things are lining up right now. But, what I would call this is more of a dead cat bounce, bear market rally, whatever you want to call it. But there's, just in my own opinion, I think we have a greater likelihood of the downside than we do of appreciation and things turning around because, across the entire economy, things are just a mess right now. So, all right. Well, if it's your first time watching here, give me a big old thumbs up, one of these. Yoo-hoo! And give me a subscribe, a like, a share, all that good stuff across all the platforms. I would greatly appreciate it. And you can see my boy Jake back here. He is hard at work, keeping us safe here at DSA Financial Group. He is the Deputy Director of Security. And again, he's usually sleeping on the job, unfortunately. So, all right, well, let's go ahead and take a peek and see how the indexes did today. Dow Jones was up 2.43%, closed at 31,827. S&P 500 up 2.76%, closed at 3936. NASDAQ up 3.11%, closed at 11,713. Small caps are up about 3.5%. The VIX fell 3.16% today. It's currently hovering around 2450. Moving on over to the other exchanges here in the Americas, Canada was up 1.84, Brazil up 1.37, Mexico up 0.61. Headed over across the pond, Germany was up 2.69, UK up 1.01, France up 1.79. The Euro stocks were up 2.15%, Netherlands was up 1.23, Spain up 2.03, Italy up 2.49%, Switzerland up 1.02%. Moving a little further east, in Russia, the MOEX was down 1.2%, while the RTSI was up 0.54. Headed over to the Asian markets, Japan was up 0.65, Australia down 0.56, New Zealand down 0.9. Headed over to the Chinese markets, the Shanghai was flat at up 0.04, the SESC component down 0.3%, the China A50 down 0.63, the DJ Shanghai flat at down 0.08, and the Hang Seng down 0.89, and the Taiwan weighted came in down 0.17%. So like I said, some red here across the Asian markets overnight, but things were really decent over the European markets earlier today. And same thing here in the U.S. Lots of 2s and 3% climbs today. So we will see how that trend continues. So let me bring up my chart here. So this is the Dow Jones. Again, this downward trend began at the early part of this year. And again, we bounced off this resistance line on a couple of different occasions today. As you can see, we are, it is crossing, but we'll see if this, continues to cross and we have, things heading in a northeastern trend, or will it bounce off and then line back up with, where we've been the last 7 months. So I would give it a higher probability to fall in line with this. We haven't really seen a capitulation in the equity markets up to this point. But hey, there's always time for a new trend to begin. So we shall see what happens long term. All right. Let's go ahead and read through today's investment or market recap. Stocks rally on strong corporate earnings report. U.S. stocks rallied on Tuesday as investors put aside worries about recession for now and soaked in the message from another slew of earnings reports. Investors are listening carefully to what companies say about how they are grappling with higher costs and ongoing supply chain challenges, and how consumer behavior is shifting after persistently high inflation. So far, more than half of the companies that have reported have beaten expectations. Stocks were rallying on Monday until a report about Apple Inc.'s slowing hiring and spending next year because of economic uncertainty threw a damper on investor enthusiasm. But the S&P 500 is climbing back above a technical level of 3,900. That could be the threshold for further gains, analysts said. By early afternoon Tuesday, the S&P 500 had reached 3,928. Housing starts fell in June to their lowest level since September after sliding in May as demand eases off from a pandemic boom. Rising mortgage rates and record high prices for homes have pushed many would-be buyers to the sidelines for now. Twitter shares rose nearly 3% after a Delaware Chancery Court judge said the social media company could fast-track its lawsuit against Elon Musk, setting a trial date in October. Musk, the billionaire owner of Tesla, had wanted a trial postponed to February to give him more time to examine data on Twitter's fake accounts. Musk, who bid $44 billion for Twitter, has recently said the lack of information on fake accounts is a reason for scuttling the deal. I've also heard as of early this afternoon, he's countersuing Twitter. So, we'll see what happens there. I mean, my personal belief is that he's going to wind up, purchasing the company at a reduced share price simply because of all the fake accounts. But we shall see what happens there. IBM shares fell 6.7% after the company reported better than expected earnings, but trimmed its estimate for free cash flow this year because of its exit from Russia and the strong dollar. Lockheed Martin Corporation shares fell 0.7% after the military contractor said sales of fighter jets fell and it lowered its 2022 targets for revenue and earnings. Oil rose. Crude oil WTI futures rose 1% to $100 a barrel, while Brent oil futures rose 1% to $107 a barrel. Gold futures were flat at $17.08 an ounce. All right. So again, as far as the earnings front, it looks like things are pretty good for now. We shall see how the slowing economy helps or hurts things, over the next quarter. But again, I think there's going to be some setbacks along the way until, we really do see a bottoming out and a retracement in inflation. All right. Building upon the housing data, U.S. housing starts, building permits edged lower in June. The U.S. housing market stayed reasonably solid in June, according to data published Tuesday, with housing starts and building permits falling only a little from May's levels. However, analysts warned that the numbers were flattered by a bounce in more volatile multifamily segment of homes and warned that a sharp slowdown is still highly likely in the second half of the year as higher prices and borrowing costs damp demand. Both data points had plunged in May to their lowest in 6 months or more as higher construction costs and mortgage rates hurt affordability. June's data appeared more benign at first glance. The number of housing starts nationwide fell only 2% on the month to 1.559 million from 1.591 million in May, a figure that was revised higher by over 40,000 from the initial estimate. Building permits, meanwhile, fell 0.6% to 1.685 million, a more gentle decline than forecast. However, underneath the headline numbers, analysts said that the trend is clearly weakening. Quote, core single-family starts and permits fell by 8%, the fourth straight declines, end quote, said Ian Shepherdson, chief economist at Pantheon Macroeconomics. Quote, home builders are responding to plunging demand by adjustments. But the adjustments has some way yet to run. Gosh, that was a mouthful. Let's see here. Where was I? Let's see here. The data came a day after the National Association of Home Builders Index of Housing Market Activity posted its largest monthly ever drop. The NAHB index is a forward-looking indicator which aims to show where the hard data on permits and starts are heading over the next 6 months. While both series are now more than 10% off of their COVID-era highs, housing starts are still at their highest level since the subprime bubble started to deflate in 2007, while building permits are higher than at any other time in the decade before the pandemic. All right, so some slowing in the housing market, which again isn't really a huge surprise. Home prices have been out of control over the last couple of years, with people exiting the cities for more rural or suburban situations. So Again, it's not surprising with interest rates, going up from basically near zero to where they're at today. I think the current mortgage rate is around 5 or 6% currently, depending upon your credit rating. So from going from like 2 something to up in the 5s, I mean, you basically have doubled the amount of interest, and so it's going to be tough. For someone who qualified for a home at rates a year ago, it's they're probably not going to qualify for the same property today, just based on interest rates. If everything else was left alone, but then you factor in rising home costs. A home that was selling for say $500,000 a year ago is probably now going for 4 or 5, maybe 10% more today. Then you add that in on top of the higher interest rates. It just really is going to price a lot of people out of the current market. All right. Another article on the Fed. I know yesterday we talked about, the Fed's mistakes over the last couple of decades. This is a little more, focusing on the now, and just a different take. This is from Brian Westbury, the chief economist of First Trust, and it's titled Refocusing the Fed. If you follow the financial press, the conventional wisdom has come to the simple conclusion that the way to fight inflation is raising interest rates. Unfortunately, this is just not true. Yes, raising rates may slow the economy, but that won't fix inflation. Starting in 2009, for 7 years, the Federal Reserve held the federal funds rate at zero, yet inflation never accelerated. So if 7 years of 0% interest rates didn't cause inflation, why would the last 2 years do it? Even though everyone talks about interest rates, it's really money supply growth that matters. I would agree with him here. I know my clients have probably gotten sick of me complaining about the massive increase in M2, which is, and he'll talk about this in a second, the M2 number growing by about 39% over the last 2.5 years, or I guess 2 years. To me, that is the main culprit of the inflation. Yes, keeping interest rates low has created a lot of malinvestment in the economy and has, created some asset bubbles, in the stock market and such. But, where we've really felt it is just the sheer size of the increase in the money supply, over the long term or over this short term period. Where were we? So if 70 starting in 2009, for 7 years, the Federal Reserve, we kept it at zero. So if 7 years of 0% interest rates, even though everyone talks about interest rates, it is really the money supply growth that matters. We follow M2 because that is what Milton Friedman told us to follow. M2 is the currency in circulation plus all deposits in all banks, checking, savings, money markets, and CDs. If M2 rises by 10%, we would expect a 10% increase in overall spending. Some of that would be soaked up by real increases in output, but the rest would go to inflation. From February of 2020 to December of 2021, M2 grew at an 18% annual rate. No wonder inflation has climbed to 9%. Raising interest rates by itself will not stop this inflation. The way to stop it is by slowing growth in M2 to a low enough rate for long enough to allow the economy to absorb the excess money. That is exactly what happened in the 1980s when Paul Volcker altered the focus of the Federal Reserve towards money. Prior to Volcker, in the 1970s, the Fed would talk about what level of the federal funds rate it was aiming for, and people started to believe it was the level of rates that mattered. But this was never the case. The Fed consistently held rates lower than the free market, and the level of inflation suggested it should, because that's what politicians wanted. In order to do that, it would add more money to the system than real growth required, causing inflation. In the late 1970s, Paul Volcker turned this approach on its head. He understood, because of Friedman, that it was money supply growth that mattered. So he targeted money growth and let interest rates go wherever they may. Some people believe he tightened money too much, and with interest rates spiking well above inflation, close to 20%, this may have been the case. But it is also why inflation fell. He kept money tight until it was all absorbed and inflation was tamed. It was slower money supply growth, not higher rates, that stopped inflation. At the same time, Ronald Reagan cut regulations, tax rates, and slowed government spending. This let real economic output accelerate, also helping absorb some of the excess money of the 1970s. So if we learned that lesson once, why do we have to learn it again? Part of the answer is that the Fed shifted from a scarce reserve policy to an abundant reserve policy in 2008. This is what quantitative easing, or QE, was all about. Under the old scarce reserve model, the Fed bought bonds from the banking system to increase the money supply, and this brought interest rates down. When it sold bonds to banks, the opposite happened. The reason this worked so well is that banks had few, if any, excess reserves. The banks used every dollar created. Think of it this way. At the end of 2007, the Fed's balance sheet, basically bank reserves, totaled roughly $850 billion. The M2 money supply, all deposits in banks, equaled roughly $8 trillion. Banks held roughly $1 in reserves for every $9 in deposits. The money multiplier, how many dollars of M2 circulated relative to reserves held at the Fed, was about 9. But all this changed in 2008 with QE 1, 2, and 3, and then more QE during 2020 and 2021. The Fed increased its balance sheet tenfold. The Fed's balance sheet is now roughly $9 trillion. While M2 has grown to $22 trillion. In other words, banks have only about $2.50 of M2 per $1 in reserves, not 9. The money multiplier has collapsed. While excess reserves have soared, the Fed has grown tremendously relative to the economy and the banking system. Why? We could speculate on that. After all, some politicians want to nationalize the banking system, but the how is equally important. Back in the 1970s, one of the Fed's tools was to use reserve requirements to manage money. If the Fed raised reserve requirements, it could slow down money creation. Today, with so many excess reserves in the system, the Fed and other banking regulators have layered regulations on banks, pushing required capital ratios from 4% to 6% to 10% or higher. Reserve requirements have been replaced by direct regulation on how much capital the bank must hold. This is why the 2008 through 2014 QE did not create inflation. The Fed grew its balance sheet, but it also increased capital requirements, which kept banks from multiplying those new reserves. The pandemic response was different. The Fed monetized Treasury debt, created new money to buy bonds. At the same time, the Treasury and the Congress used banks through PPP loans and direct deposit stimulus checks to distribute, quote, stimulus, and the Fed eased liquidity rules to allow this to happen. M2 growth exploded. In fact, it has grown 41% since February of 2020. So my guess of 39%, I was a little bit off. So 41% appears to be the more precise number. So how does this get reversed? Once the Fed allows more M2 to be created, it can't destroy it. All those deposits are owned by someone, you, me, your employer, or the Treasury. The Fed can't take them away. They are private property. There are only 3 ways to limit money supply growth under the abundant reserve model. First, by paying banks interest on their reserves at a high enough rate to keep them from lending. But this approach means that at a 3.5% rate, the Fed will be paying banks roughly $120 billion per year. This may or may not stop them from lending, but it will certainly not make them politicians. Like Elizabeth Warren, very happy. Second, the Fed can raise capital requirements as it is already doing. Last week, JP Morgan was forced to raise its Tier 1 capital ratio to 12.5% from 11.2. Jamie Dimon, the CEO of JP Morgan, said these rules were capricious and arbitrary. He is correct. They have nothing to do with the bank themselves and have everything to do with slowing money supply growth. At some point, however, this becomes ridiculous. Banks are better capitalized and have more liquidity than they probably ever have. The third has little to do with the Fed. If the Treasury ran a surplus like it did in April, it could reduce its debt and allow the Fed to let bonds mature. But this is unlikely to last. The U.S. has what appears to be a permanent budget deficit, and that is likely to change under current leadership. We are not saying that raising interest rates won't cause a recession. What we are saying is no country in the world has ever had a massive inflation problem under the new abundant reserve policy model. We are in uncharted territory. Raising rates alone is an untested tool to slow or stop M2 growth. Some people say that the velocity of money is falling, and so we don't need to worry about M2 as much. Slower velocity will help get inflation back down and keep it there. Slower velocity means every dollar boosts the economic activity by less than it used to. But this is a feature of the abundant reserve model, not a bug. As the Fed grows its balance sheet, bank balance sheets grow as well. But this money is not allowed to circulate because of higher and higher capital requirements. That's why velocity has fallen. Velocity itself has not changed. Money has. The thing that worries us most is that the Fed will keep growing its balance sheet and government's power by regulating banks to the point where capital requirements hit ridiculously high levels. And this brings us back to Paul Volcker and Ronald Reagan. By slowing the growth of money, Volcker took the Fed out of the business of juicing the economy. By cutting tax rates and reducing regulations, Reagan revived the private sector. This ended stagflation and led to a boom in the economy. How do we end the current trajectory and fix our problems all over again? The answer would be to shrink the size of the Fed's balance sheet by massive amounts. It is way too big, and it is regulating banks in an extraordinary and unprecedented fashion. And while we sound like a broken record, shrink the size and scope of the federal government as well. Putting these two policies together, just like the U.S. did in the early 1980s, will end stagflation we haven't seen since the 1970s. I agree with a lot with him here. What he's really pointing out is it's not just an inflation problem or a interest rate problem. It's a money in the system problem. And while raising rates will help, help slow things down and slow the amount of money creation down. In the end, we're going to have to slash government spending and really revive the private sector instead of so much public sector spending. All right. Another article here. This one has to do more with us being fleeced as taxpayers. So let's go ahead and read through this one. Comes from Zero Hedge. America just bailed out a bunch of pensions at the taxpayers' expense. Hey, awesome. I love being robbed again. Unnoticed by most taxpayers and touted as good news was the fact that we, the taxpayers of America, have stepped up to the plate and bailed out hundreds of failing pensions. Much of this took place without the average citizen even knowing it occurred. The American Rescue Plan Act of 2021 was the $1.9 trillion economic stimulus package proposed by President Joe Biden to speed up the United States' recovery from COVID-19. The huge bill was passed with little time for debate or even to be read. All under the idea Congress needed to take action to address the economic and health effects of the pandemic and the ongoing recession. While how this provision to assist troubled pensions has been addressed did not get a great deal of airtime, it may prove to be far more costly than predicted. People are often led to believe pensions are a promise carved in stone. However, when the money is not there, pensions and promises will be broken, so pensioners should prepare for the pain. This is especially true of the public sector, which has a history of granting pensions that are unheard of in the private sector. The 25 largest U.S. public pensions face trillions in unfunded liabilities. If Americans took the time to stand back and look at the bigger picture, they would probably see the Pension Benefit Guaranty Corporation, the PBGC, an independent agency of the United States government responsible for acting as the nation's, quote, safety net for failed pensions, is also in trouble. When a pension fails, this agency is expected to take control of its assets and dole them out to its pensioners in the coming years. The ugly truth of the PBGC is not a rock, but it is in need of its own bailout. Let's see here. Josh Gottbaum, former head of the PBGC from 2010 to 2014, voiced his unhappiness with Washington leaders failing to confront this reality when he said, quote, "No one wants to admit that pension benefits have to be cut, and therefore in public, no one wants to be seen supporting anything that cuts benefits. However, unless some benefits are cut, all are cut. It is likely the future will prove him right. We're only at the beginning to see the tip of the iceberg when it comes to the growing problem and just how many of these schemes are underfunded. This is not just a problem only in America, but exists all over the world. Pensions are pensions are giant pools of capital responsible for paying out retirement benefits to workers. And right now, many pension funds around the world simply don't have enough assets to cover retirement obligations they owe to millions of workers. Governments have lulled their populations into a false sense of security based on financial promises they are not going to be able to keep, and most likely will exacerbate generational conflict going forward. This is not simply a political problem, it's an arithmetic problem for which no real answers exist. Recently, while speaking in Cleveland, Biden used the occasion to announce the agreement to implement a financial assistance program for multi-employer pension plans. In a speech where he was joined by union workers, retirees, President Biden said, quote, "We turn a broken promise into a promise kept," end quote. Adding to the cost of this bailout, Biden bragged, quote, "Those retirees who lost benefits will have them restored retroactively," end quote. Boy, that is sure nice of you, Joe. A man who's never had a job in the private sector is promising away our money all over again. I just love it. Under the American Rescue Plan, certain unfunded multi-employer plans were allowed to apply for taxpayer-funded assistance to help them stabilize their finances and restore benefits that were previously cut. It should not surprise any financially conservative person to find the interim rules for this program issued by the Pension Benefit Guaranty Corp. drew criticism from pension consultants, plan trustees, and other experts for not being generous enough to ensure the long-term survival of these troubled pensions. The current solution allows plans to invest a portion of their financial assistance funds in higher return assets. The White House claims this modification in the final rule helps create a situation that allows plans receiving assistance to remain solvent and pay full benefits through at least 2051. The rules allow plans to invest up to 1/3 of their financial assistance funds in higher return assets and stocks rather than the safer investment grade bonds. To be clear, this is a bailout, and it could be argued that it allows them to mismanage funds and get into trouble again. Before the American Rescue Plan, over 200 of the nearly 1,400 multi-employer plans were facing near-term insolvency. This threatened to leave 2 to 3 million participants without their full earned benefits. These multi-employer pension plans were created through agreements between unions and 2 or more employees and covered nearly 11 million participants, many of them in industries such as construction, trucking, and manufacturing. As noted many times on this blog site, pensions are in many ways the biggest Ponzi scheme of modern man. Many of the plans have overpromised while being hit hard by a decline in unionization, employer withdrawals from the plans, and investment losses. While a 2014 law allowed some troubled plans to slash the benefits of current retirees, the idea conflicts with protections enshrined in the federal pension law. Excuse me. The new 33% limit on stocks and other higher return investments is intended to allow plans to grow their financial assistance funds, increasing their ability to pay benefits through 2051. This so-called financial assistance program also extends to 2055, the solvency of the PBGC's multi-employer insurance program, which was previously expected to run out of money in 2026. Of course, it is logical the troubled PBGC would do anything it can to put lipstick on the unfolding pension debacle and halt flow of failed pensions into its system. We should not focus on the fact that the PBGC has already approved over $6.7 billion in financial assistance for plans covering over 127,000 workers and retirees. We should instead look at the real long-term costs and ramifications of this bailout. The agency, which ensures defined benefit pension plans, expects it will ultimately distribute $74 to $91 billion worth of financial assistance to these plans by numbers flowing out of Washington are often wrong. I expect the real cost of the pension bailout to be far greater than anyone can imagine. I join those few congressional Republicans who pointed out this deeply flawed bailout of a select group of privately managed retirement plans that creates perverse incentives for further mismanagement and underfunding of pensions. Not only does it pave a way for more taxpayer bailouts of pensions, but it also continues the dangerous transfer of wealth, which leaves the taxpayer holding the bag. Awesome news. We, the taxpayer, get screwed again. So, these pension plan or these big companies, and well, a lot of them are for the public sector, and they overpromise, and who winds up picking up the tab? Us. And it gets really frustrating at times. So, all right. Well, that's everything I had for today. I hope the news wasn't too depressing. I mean, the stock market was good, so I figured I'd throw in a couple of articles that were not necessarily the most exciting, but makes you aware of, like yesterday we talked about, what did we talk about yesterday? What was the articles we covered here? As far as how we got to where we're at today, and let's see. And the hiring slows at Apple and all the other things that were going on. So, from day to day, I don't always remember what I talked about. So anyways, all right. Well, hope everyone has a fantastical evening, and the All-Star game's tonight. So it's not that exciting. It's a fake game, but for those who like watching that sort of stuff, more power to you. I'll probably listen to some podcasts about the economy or aliens. I listen to a pretty diverse group of stuff. So hope everyone has a fantastic evening, and I'll see you guys tomorrow. Bye-bye.